Today's session is especially critical as we are focusing on the future corporate reporting. This guest lecture reflects the idea that we have come here to communicate and collaborate with others, sharing our past experiences and ideas for the future. Especially, we will be focusing on the discussion of corporate reporting, which is thriving in disruptive times and integrated thinking, provide information and expertise to help us find solutions to the challenges we face today. Similarly, the concurrent session with key issues in not just for accounting profession, but also for the global business environment in which we operate. This session promises to be informative, interactive, and innovative, and I personally look forward to attending them. Lastly, coming here is of us realize we must look beyond today to for instance, how our profession can sustain and enhance its relevance tomorrow. And hopefully, this will lead the sustainability corporate reporting that continue to contribute to the economic growth and sustainability. I do really hope that we will get in touch with Professor Richard Barker. I am hoping we can have more collaboration with you. We are confident that today's guest lecture event and the upcoming series will be useful building block and tools in the volatile and uncertain corporate reporting. Please enjoy today's session and do stay safe. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Ini kan topiknya.
Okay, thank you, Dean, for your opening speech. Okay, Assalamualaikum warahmatullahi wabarakatuh. May God bless you all. Students, faculty members, college participants, and ladies and gentlemen, welcome to the third podcast lecture series from Accounting Department. First of all, I'd like to introduce myself. My name is Basuki. As I said before, for Indonesian it's not so strange, but for Western people maybe it's very strange that people only have one name. So I just double my name, become Basuki to be accepted in international area. And then today we have very distinguished speakers, Professor Richard Barker from UK. As you know that the disruption technology caused by Industrial Revolution 4.0 as well as the recent vision, such as climate change, bring many consequences in many aspects as well as in our discipline, accounting. In reporting, we are not now only reporting our financial aspect, but also more than that. We have to report social, natural, or environmental aspect. Integrated reporting and sustainable reporting become new issues should be taken into account. IFRS Foundation has announced a new board called International Sustainability Standard Board. And very fortunate today, we have Professor Richard Barker as our guest speaker. He will talk about the future of corporate reporting. So first of all, I would like to introduce our distinguished speaker by reading his CV. Richard is a Deputy Dean and Professor of Accounting at the Said Business School, University of Oxford. He earned his PhD at the University of Cambridge. Maybe I will share a screen so it's much better to audience to. Okay, I think you can see the. Okay, research interest and recent publication. His research focuses on corporate reporting and on the design and standardization of information by which corporations account for their performance. This includes, on the other hand, international accounting standards and investors' use of financial statement information, and on the other hand, business performance metrics that are concerned with long-term business sustainability and accountability. In 2021, Accounting for Intangible Asset suggested solution in accounting and business research. 2020, integrated reporting and IFRS competing frameworks in the Routledge Handbook of Integrated Reporting. Another 2020, moving the conceptual framework forward accounting for uncertainty in contemporary accounting research. And on 2019, corporate natural capital accounting in Oxford Review of Economic Policy. Richard has won teaching award on both Oxford and Cambridge, including most acclaimed lecture in the social science awarded by Oxford University Student Union. Before I give time to Professor Parker, I just want to read the ground rule for this webinar today. The guest lecture is being recorded and live streamed. Please stay mute until called upon. This for the participant. Turn on the camera and use Zoom virtual background that has been shared. Rename the Zoom account in the format name _ institution name. And on QA process, use Slido features to ask questions in chat. Visit https www/slido intercode name number GL0003 or visit this website. Treat everyone how you like to be treated and enjoy the guest lecture. So I will stop share and then I will, Professor Parker, you have about 45 minutes for presentation maximum, and then there will be a Q&A. And then I think it's time now. The time is yours, Professor Parker. Thank you.
Thank you, Basuki, for that kind introduction, and thank you everyone for being here. It's nice to be able to do this. One of the great features of COVID is it's created these kinds of interactions and made them normal, and that's especially important, I think, in the subject that I'm going to talk about, because the issues of the future of corporate reporting are very much connected with issues of sustainability, financial sustainability and sustainability more broadly, and issues of sustainability are global, they're not local. And so me giving seminars in person locally around Europe is actually not as useful, not in the bigger picture, as being able to engage internationally in this way. And I think actually Indonesia is a particularly good illustration of this. If you want to look at the tensions and the challenges of rapid economic development and impact of climate change and impact on biodiversity, Indonesia is a hotspot globally. It's one of the, I think probably when I talk about biodiversity in particular, if I refer to two places in the world, it's Indonesia and Brazil are the kind of the two most obvious test cases. So that might not be obvious to you because Indonesia is home, right? But if you're looking at biodiversity impact, if I look at my little island off the north of Europe here, not only is it small, And not only is it in terms of biodiversity nothing close to Indonesia, but also whatever the biodiversity we had, we destroyed a few hundred years ago. There's not much left, right? So there's not much to see here, really. The impact of climate change, obviously, is significant here. But again, you think about, well, what's the sort of the challenges facing Jakarta and the questions about location of the seat of government and so on. We don't face those kinds of questions here. That sort of urgency and that scale of challenge. We will do if climate change continues as it is and sea levels rise as they are expected to. Then London is projected to be underwater. So then things will change in the UK, but not yet. It will take some time. So thank you for inviting me. So I got 45 minutes. What I'm proposed to do is just run you through a series of slides which just give an overview of this incredibly topical area, an overview as I see it, and then I'd be very interested to open up for questions. I think that's where the real value of this interaction is. So just to say at a very high level bit of background, this is in many ways the most interesting, dynamic and changing period in the history of corporate reporting, let alone, sort of interesting in and of itself. If corporate reporting, if you think about it, goes back a very, very long way, right? So we associate financial accounting with its origins with the north of Italy in the 1400s or thereabouts. So that's when we started getting actually, I'll share my PowerPoint because then I can control the. Am I able to share slides at my end, because it might probably be better in terms of the flow of the presentation. Let me try that and. There we go. You can see it, okay? Can you?
Oh, that's okay.
Okay, good. Yeah. So just to say, if you look at the history of corporate reporting, the presentation here is about the future. But if you think about the history, it's around about the 1400s where we started to have financial reporting as we know it today, balance sheets and income statements, and that basically hasn't changed in all that time. So accounting standards, norms by which we control financial reporting, started pretty much with the Wall Street crash in 1929. So they're about 100 years old. And they've evolved very slowly and gradually. And we now have international standards. And that world continues to change, but it's not changing. Hasn't changed very rapidly, and it's not going to change very rapidly. Whereas the world of ESG or sustainability or whatever you call it reporting is dramatically changing the way in which companies are held to account. So what I thought I would do is, and it's all happening now. It's happening in real time. So there've been significant announcements in the last week or two in this space. Okay, so what I thought I would do is just start by talking a bit about the financial accounting model that we have, because this is the benchmark. This is the base case. This is what's already in place. So in thinking about the future of corporate reporting, the question really is, well, what's wrong with the past? Why is what we've got already not enough? Why is there all of a sudden such pressure to develop and expand this system? What's wrong with it, right? So the basic model, the basic model is very simple, actually, at heart, and as you will all know, that we have. So you look at the top statement, we report financial performance to shareholders through the financial statements according to IFRS. Now, notice several things here. Firstly, this is a system for reporting performance ultimately. Profit is the bottom line of this system in terms of the most obvious measurement output. Why profit? Well, because profit is a measure of change in shareholders' wealth. Why change in shareholders' wealth? Because that's how corporate law is structured. Companies are, by the design of the financial statements, as you can see here, but more generally by design, company directors have a particular duty towards their shareholders. It doesn't mean that shareholders are all that matters. It doesn't mean that shareholders own companies, because they don't. But the system of corporate reporting is geared towards reporting, accounting for financial performance of the shareholders' investment in the company. And the way in which that's done is historical. So the scope of the accounting system is assets and liabilities controlled by the reporting entity, controlled at the reporting date as a result of past events. So the way that assets and liabilities are defined is that something in the past must have happened in order for there to be an asset or a liability now. So there's no anticipation of the future going on here. There's measurement of assets and liabilities that exist now. So, an asset is valuable because it is expected to generate cash flow in the future. But that's not the same thing as trying to measure the future. It's measuring the present. It's putting a number on what the value of the asset is now. So IFRS measures assets controlled as a result of historical events, liabilities owed as a result of historical events, and equity is the difference, and profit is change in equity. And that's the system. And the system is universal. So IFRS is universal. Even in the US, you've got US GAAP, but it's pretty similar to IFRS. Much is made of the difference, but the similarities are overwhelming. So you basically got one system of accountability to shareholders for financial performance. And that's worked very well in many ways historically. Now, notice it is historical. And if you're an investor investing in a company, you're actually not interested in the past. You're interested in the future. And so something quite strange is going on here, that we have a system of reporting that tells people what has happened in the past, when what they want to know is what will happen in the future. And there are two reasons for this. One reason is that it is possible to measure the past. It is possible to provide reliable, verifiable information about what has happened in the past. It is impossible, in principle, to do that about the future, because the future hasn't happened. So, in a sense, the system is saying, we can provide you with, relatively speaking, reliable information. You'll need to find other information from elsewhere, but what the accounts will tell you is what has happened in the past and how well the company has performed. So that's fine, actually, as long as the past is a good guide to the future. So if the amount of revenue a company made last year and its operating expenses last year are a reasonably good foundation for forecasting what its revenue and its operating expenses will be next year and the year after and the year after that, then actually what you have here is not just what happened in the past, but also a basis for forecasting the future, a reliable basis for forecasting the future. And that's what investors want to know. So as long as we're in a period of not quite steady state, but gradual change, where there isn't any great disruption going on, then financial accounting works quite well as an information system. Now, and one more thing to say, it works quite well as an information system if it's appropriate to construct. If it's appropriate to construct the accountability of the corporation as being to its shareholders for financial performance. Okay, so notice those two things. The past is a good guide to the future, and companies report to shareholders on financial performance, and that's the purpose of the system. So that's how accountability has worked historically. Why is this a problem? Well, it's fine if you are a business which is going to continue, expects to continue in the future as you have operated in the past. So here's an example of this. Aramco, I think the world's second largest company, the most valuable company, I think, at the moment, sits on the huge oil reserves. Aramco, this is its mission statement, is focused on maintaining its preeminent position in crude oil and the hydrocarbon value chain. Okay, so if you look at that and you say Aramco is a business which we know very well what it does, we know it's good at what it does because we can see its historical performance, we know how much money it makes from oil and gas, and it's saying our business is to carry on making money from oil and gas in the way that we have done in the past. So for that type of mission statement or that type of corporate purpose statement, financial accounting seems to work quite well. It also works reasonably well for an ExxonMobil type statement. So ExxonMobil are basically saying, we're also a hydrocarbon oil and gas business, but we will not operate responsibly. So corporate reporting for the past, I don't know, 20 years has been of this type that fits the ExxonMobil model. It's been a system of reporting which says, primarily, we are all about making profit for shareholders. However, we recognize that we have a social license to operate and we must operate responsibly. So sustainability reporting, or CSR, corporate social responsibility reporting, is secondary and separate from the main business of financial corporate reporting. Now contrast that with BP. And this is increasingly, this is not just BP, this is an increasingly common purpose statement that oil and gas companies are making. The BP, their claim, right, and you can agree or disagree, their claim is that their purpose is to reimagine energy and to help the world reach net zero. Okay, so they are saying our business, the focus of our business is to stop doing 99% of what we're currently doing. Basically, our business is to completely transform our existing business. Now, notice if that's the mission, then the historical profit that BP has made from oil and gas is increasingly irrelevant, because what they're saying is that's not the future of our business. So if you're an investor in BP, what you want to know is, how are they going to make profit from reimagining energy? Is this wind? Is this solar? Is this hydrogen? What is it? What are you going to do, BP? How are you going to make money in the future? So they're asking very different questions than they were asking in the past. Notice, by the way, in the little bio introduction that you had to me, you saw papers on intangible assets and uncertainty in financial reporting, and also on sustainability. They all raise the same questions, actually. So, if there's great uncertainty about the future, if accounting doesn't do a very good job of capturing that uncertainty, which it doesn't for intangible assets, then you have this problem that the financial accounts, the historical financial accounts, do not provide a good guide to what will happen in the future. So we have a discontinuity, and this is a really, I think, good way of illustrating the discontinuity. The blue part of this chart is carbon emissions historically on an annual basis over the past 100 years or so. So what you see is up until the Second World War, gradually growing, but quite relatively speaking, low levels of carbon emissions. And then post-war, a big spike, and then more recently, an accelerated spike. Now, if you were to do a graph of global growth in GDP, it would look the same as the blue chart. It would grow in the same way. And this is not surprising, right? And as we've grown economic activity, so we've grown the energy that is required to fuel that activity, and so we have grown carbon emissions because the energy is. So from where we are now, this chart is slightly out of date, but where we are now, in order to meet the Paris climate targets, we need to be on the grey line in terms of the future of carbon emissions. So we need a dramatic turnaround in the future, and a disconnection between growth and environmental impact. This is why BP is making the statements that it's making. It's not saying we BP have become an environmentally friendly business and we've become a socially aware business and we care about people and planet. It's saying we BP think that the best economic future for our shareholders is to profit from that grayscale and going down in carbon emissions, rather than to pretend that we can carry on profiting from historical blue line on this chart of carbon emissions in the past. Okay, so BP is saying we have made money. Our business looked like the blue line. Our business needs in the future to look like the grey line on this chart, essentially. So it's a shareholder value statement that BP is making. Here's one much closer to home for you. So this is deforestation in Borneo, primarily associated with the palm oil industry, as you will know. So what you see in the top left is tropical rainforest cover in 1950, which would have looked the same in 1850 and 1750 and 1050 or 50 for that matter, right? So the 1950 picture is the historical, long-standing. It's always been this way. And what you see is a decline in natural rainforest cover, which is, if you look at that, it's a similar rate of decline in rainforest as you just saw increase in CO2 emissions. In fact, if you look at any chart of climate impact or biodiversity impact, whether it's on water or forest or soil or land use, or plastic emissions or waste emissions, whatever it happens to be, or species loss, they all look the same. They all show this dramatic increase in the second half of the 20th century and into this century. And the reason this matters from a corporate point of view is that it's not sustainable. It's not economically sustainable. For companies to be able to continue making the profit that they are making, they are increasingly having to think quickly and dramatically differently about the source of their activities, the economic source of their activities. And so investors, therefore, want quite different types of information from companies than they needed in the past. If you were Unilever is a company that gets lots and lots of positive praise in its sustainability agenda. So let me turn that around just to illustrate the point and view it in the negative. Unilever is one of the main, historically one of the main consumers of palm oil, of course, and the Unilever business has profited from the decline that you see in that chart. It cannot continue to do that because the resources are not there for it to continue to be able to do that. So what Unilever has done is to try to create some sort of roundtable for sustainable palm oil, which tries to provide an ongoing, financially reliable supply, as it were, that can support their ongoing business. Okay, wrong way, sorry. So in response to all of this, the IFRS Foundation, and Basuki mentioned this already, the IFRS Foundation has created an International Sustainability Standards Board. And so there are now two boards. There's an International Accounting Standards Board and an International Sustainability Standards Board. And I want you to think of it this way. The Accounting Standards Board does what accounting has always done. And the Sustainability Standards Board does what the future of corporate reporting is increasingly looking like. Very important, what they are doing is providing information to investors about the financial sustainability of the business. The point is, that I've just been trying to make, the point is, you can no longer separate environmental impact of a company from its financial sustainability. So back in 1950, Unilever could consume as much palm oil as it wanted to consume without having to think twice about environmental impact. That did not affect the economics of the business. Now it does affect the economics of the business. So this is an investor-oriented initiative, but it's driven by the constraints on economic growth imposed in effect by planetary boundaries. There's also other very significant developments going on right now, and Europe in particular, and sadly, being a British citizen, this no longer means the UK. You know, the UK is no longer part of the European Union. But Europe is doing pioneering, leading work in this space, changing legislation rapidly across all aspects of European economic activity. It's very impressive, actually. And one of the things they're doing is they are introducing a corporate sustainability reporting directive, which will apply not just to listed companies, but to all companies. And that effectively will require companies to report on their environmental impact in quite a granular way. So this is a dramatic and mandatory change that is taking place. And this, I won't go through all the wording on the slide, but this gives you some indication of the scope of the EU's regulation. You see those 6 bullet points there. Notice they are all about, in substance, about sustainability of economic activity. If you don't protect the environment within which economic activity takes place, the economic activity itself cannot be sustained. So there's a very broad social lens going on here, but the implication is that for companies, they're going to have to change dramatically the way that they report. Likewise for investors. So if you're an asset manager, a fund manager offering products within Europe, you're going to have to declare how many of to what extent your investment portfolio meets basic sustainability criteria. That is increasingly relevant to your ability to generate funds, investment in your funds. Meanwhile, in the United States, the SEC has just a couple of weeks ago issued, so this slide is now old, but so this is how rapidly the space is moving. The SEC has issued 2 weeks ago guidance on climate risk disclosures. This is a 500-page document if you have the time to read it. So they're taking it seriously. There'll be a lot of discussion, a lot of challenge, a lot of very strong views on both sides. But basically, the SEC is saying investors in American capital markets, right? This is not tree huggers, right? This is mainstream capitalism. Investors in US capital markets need climate information. Now, if they're successful with this, which in everyone's collective interest, let's hope that they are, then this also then raises the question of other external impacts of corporations and the extent to which those are threatening to the economic and social environment within which business operates. So the kind of biodiversity issues I've just talked about, and also issues of income inequality and wealth inequality and so on. Okay, John Maynard Keynes, I assume is well known to you, and he, at the beginning of his general theory in 1936, it's an old book but still quite a brilliant one, he said, practical people who believe themselves to be quite exempt from intellectual influence are usually the slaves of some defunct economist. In other words, we all grow up with certain ideas in our mind about how economies function. You know, we have some notion of what Adam Smith said or something, and that shapes the way we think. And there are 2 things in particular that are, I think, unhelpful in this area that shape the way people think. One concerns externalities, the other concerns valuation. An externality is where there is an impact in the economic system that is not felt by the 2 parties who are engaged in a contract. So Aramco sells oil to a customer, or BP for that matter sells oil to a customer. BP's customer burns the oil, that emits carbon. The damage to the planet from emitting the carbon is not part of the pricing of BP selling the oil to the consumer, and not part of what the consumer is paying. So it's an external cost. The reason that externalities, I think, are unhelpful is that an externality feels like it's not relevant to financial reporting. Why would investors care about costs that are not imposed by shareholders, not incurred by shareholders, which by definition an externality is? The reality is that argument doesn't hold up anymore, because the implication of being a business with high externalities is that you're not going to be able to generate value in the same way in the future. So the BP example illustrates that, but in general, the very strong direction of travel is increasing awareness of external impact, and that affecting the economics of the business in the future. So things that are current externalities are unlikely at some point to be externalities in the future, and they're therefore relevant to the present value of cash flows of any given corporation. So externalities, reporting of externalities absolutely is value relevant, and the more impactful the externality, the more value relevant it is. Climate is the obvious example, and what I've just described to you in the EU and internationally and in the US illustrates how companies are in the process of being required to report on externalities in the interest of shareholders. The other thing that's unhelpful is valuation. Accounting is not valuation. When we think about externalities, we tend to get driven immediately to the way an economist thinks about externalities. You know, what's the economic value of the externalities that are imposed, or both positive and negative? That is a very unhelpful way of thinking in a variety of ways, but one to draw your attention to is that's not the way accountants think. So financial accounting is not based upon valuing intangible assets or valuing expected future cash flows. It's based upon recording what has happened. And so too environmental accounting ought to be about recording what has happened, not putting valuation on what hasn't happened. So reporting a carbon impact, reporting a carbon footprint, you know, what were your carbon emissions last year? That's accounting information. Reporting what do you think the impact on your business will be from climate change, that's not accounting information, that's valuation. That's part of broader corporate reporting. And it's important, I think, to make that distinction. Okay, so I have a paper in this space. I'm happy to circulate, Basuki, if that would be helpful, exploring how accounting can be, and financial reporting in general, can maintain a system of financial accounting, the system we've always had, but at the same time provide sustainability related information, because the future of corporate reporting is going to be primarily in the expanded disclosure of sustainability related information. That's where we are right now. So through the lens of financial materiality, there are two quite distinct types of information that investors want. They want to know what was your profit last year and what are your assets and liabilities now? And they want to know what kind of business do you have in terms of its environmental and social impact, and how do I therefore need to think about the future of your business? So the first bullet point here, the financial accounting, is IFRS, what we've already got. The second bullet point is what the ISSB will do, and what the SEC is requiring, what the EU is requiring, and so on, which is reporting this additional sustainability information. Now, an additional question is how to think about corporate performance from an environmental perspective, because if you just focus on investors, investors are not the only stakeholders of a corporation. They're not the only parties affected by corporate activity. And the really serious issues that we are facing, that we're dealing with, of climate change and biodiversity loss and so on, these things which are existential and potentially cataclysmic. And it's important not to understate that. It's not alarmist to make those kinds of statements. Those issues are not obviously addressed by considering how a company reports to its investors, because its investors are not all of society. There are stakeholders in society other than investors. So how should we think about environmental materiality lens on the company? Well, a helpful way to think about it, which is the way integrated reporting operates, and it's grounded in an economic way of thinking, is the notion of natural capital. So think about natural capital as being the resources of nature. Think about natural capital as being a stock, and nature provides a flow of ecosystem services. That's a flow. So natural capital is analogous to financial income. The expected flow of ecosystem services, air and fresh water and agricultural produce and so on. Those things are analogous to profit. They are the flow from the capital. If you want to maintain the environment, you've got to maintain the natural capital. in a sense, you know, the very notion of sustainable development is all about that. The notion of sustainable development is don't consume your capital. Make sure that you maintain your capital in such a way that future generations can also benefit from it. So what you just saw in the deforestation of Borneo is a very clear example, and there are many examples, but it's a very clear example of the destruction of capital in order to provide consumption in the current period. That consumption from current generations is at the expense of the potential consumption of future generations. So the notion of natural capital is looking after nature, essentially. One way to think about this is to say, think about natural capital, think about nature as a person, in the same way you think about a company as a person. A company is a person in law. So, you know, if financial reporting is about reporting the performance of the legal person, the natural capital reporting is about reporting the performance of the natural capital person in some sense. You know, how has that person been harmed, or have they benefited in the reporting period? Not all natural capital matters. Natural capital matters if it can't be substituted, and if its loss is potentially irreversible and serious. So, you know, the Himalayan mountains are not critical natural capital. They're not going anywhere. The water that sits in the form of snow and ice on top of those mountains that provides water flow into India, that is critical natural capital. Because if the effect of global warming is to significantly diminish that flow, then many millions of people are at risk. Natural capital is something that we influence, yet it's not something that we have a good sense that we understand well, and it's not something that, having influenced it, we can necessarily stop. So once you get into a global warming cycle, the positive feedback loops in that cycle can make the problem worse in a way that spirals beyond our control. So, you know, it won't be long before there is no ice in the North Pole in the summer period. It will just have disappeared, which is a pretty dramatic indication of the impact of climate change. Once that happens, then the heat of the sun doesn't get reflected back off the white ice. It gets absorbed by the dark sea, and that reinforces the warming, and so on. So there are many positive feedback loops of that type, and we don't know what would happen once the system gets out of control, which again suggests a critical role for maintaining natural capital as it is now. Final point: irrelevant is the current economic value of natural capital. So if you're nature, you're this legal person that is nature, you don't care about putting prices on natural resources. What you care about is maintaining the natural ecosystems that have always been there and that have always supported life on Earth. So economic valuation is quite dangerous in this space, actually. In a sense, it invites the assumption that natural capital can be substituted with other forms of capital. That you can put a value on natural resources, you can put a value on intangible assets, you can put a value on, you know, Netflix or something. And these are in some sense equivalent things. They're not equivalent things, because the future of people on the planet can survive without Netflix. It can't survive without natural capital. Okay, so that's the point I've just made. The way we do accounting ignores all of this. The way we do accounting is we ignore externalities by definition, and we treat assets as substitutable. And we capture market transactions, and the market transactions reflect decisions of people with current generations with money, not current generations without money, and not future generations. So we have a very partial measurement system. So if you want to look after nature, as it were, if you want to protect the environment in such a way that future economic activity is protected, then you've got to take care of natural capital maintenance. I think that's unavoidable. Notice the protecting of future economic activity, which I keep coming back to. It's very important. A world in which we allow continued depletion of natural capital at the current rate is a world which is less valuable. The ability to generate economic value in the future is damaged by not operating sustainably. In other words, there is an economic case, a very, very strong economic case for operating sustainably. There's no inherent conflict here between the economics and the natural, as it were. So when we think about an income statement for a company, which takes into account all of this, would be to say, report IFRS profit as normal, so revenues and expenses, but then also report the cost of externalities, and then report some measure of sustainable profit. And what this would do, in effect, is say, our IFRS profit was, whatever it was, 200 in this case. But in order to make a profit of 200, let's just talk about carbon because that's easiest. We imposed 80 of environmental impact because of our carbon emissions, of which 20 was in our own operations and 60 was scope 3 in our supply chain. The notion here is that if a company were to report the cost of making good damage to the environment, then the meaning of sustainable profit would be, in this case, 120 is the amount of profit we would have made if we had not damaged the environment. Okay, so imagine there's deforestation involved in the operation. Whatever the cost of reforestation is, as it were, is the cost of the externality in this case. The notion is one of replacement cost. So taking natural capital as the thing that you are seeking to maintain, what would it cost you to maintain that thing? And there's all kinds of issues in there, practical issues around measurement and so on, but in principle, it's very clear. What would be the cost to the entity of operating in a way that did not impose negative externalities? This is a summary slide of much of what I've been saying. So I'll spend a few minutes on this, and I've got a couple more slides, and then we can go to questions. So these 4 boxes are designed to represent different components of corporate reporting. All of corporate reporting in the past essentially has been box 1. I exaggerate slightly, but financial accounting overwhelmingly is the focus of corporate reporting. So we know box 1 very well. What I've just been talking about is box 3. Now, box 3 is added to box 1, gives you this full cost income statement or sustainable profit. So box 3 is information we do not currently report. Nobody currently reports. There's no regulation to report it, no requirement to report it. But it would be a measure of actually, in total, what's the economic impact of a corporation? So a corporation generating a profit means a corporation is creating value for society. Fine. The value of that society, net of the negative environmental impact, is a better measure of the overall impact of that corporation. So that's box 3. Box 2 is the provision of sustainability-related information to investors. So this is BP saying to its investors, here's how we're going to make money from wind and hydrogen. Or it's Aramco saying to its investors, here's why we don't think we're going to be affected by climate change and why our business will carry on operating. So it may be Aramco saying to its shareholders, we are going to invest $150 billion in carbon capture technology. And we expect that by the year 2035, that carbon capture technology will be fully effective. Or it might be Aramco saying, the world will continue to need fossil fuels for the next 30, 40 years. So the question is, which fossil fuel operations are going to close down and which ones are going to carry on operating? And they might quite reasonably make the case that says, look, Aramco has efficient access to oil and gas in a way that somewhere like Canada doesn't, for example. So Canadian oil and gas operations are at much greater risk of being closed down than Saudi oil and gas operations. And therefore, as part of the world's transition to net zero, Aramco will continue to provide fossil fuel for decades to come. So the point is, box 2 is explaining to investors why these massive factors, environmental factors that affect the economics of society as a whole, why they do or do not affect the company and the investment in the company. Box 4 is reporting to stakeholders other than investors on things that sit outside the account. So, for example, a society might have concerns about particular elements of social impact. And those elements of social impact might not be something that directly concern investors. But nevertheless, stakeholders in society as a whole want to know about whatever it happens to be, whether it's the company's record on human rights, or whether it's whether the company is paying a living wage in its supply chain, and so on and so forth. So box 4 is disclosures of that type. It's disclosures that are relevant to stakeholders, although not valued, at least not valued currently by investors. Okay, so here's one way to make sense of all the various initiatives that are taking place in this very confused space right now. The box on the left, financial materiality. The question here is, when a company provides information, is that information relevant to investors or is it not? If it is, then I'm going up the algorithm here. So I'm here now. If it is, does the reporting system require a measurement of profit? If it does, that's IFRS. If you're reporting to investors, but you don't require a measure of profit, then that's where all the various initiatives are taking place right now, really. So TCFD, the Task Force on Climate-Related Financial Disclosure, the SEC initiative, the International Sustainability Standards Board, and so on, are all providing sustainability-related information to investors. If the question is, actually, we're not just concerned with financial materiality, we're concerned with materiality to stakeholders in general, to society as a whole. And you then ask the question, is there a requirement to report a measure of profit? Then you would end up with a full cost income statement. This is something nobody does. So that's an empty set. On the other hand, if the question is, no, we're not trying to put a profit number on these things, but we do want information, that's where GRI and the EU initiatives are focused on, in this area of double materiality, providing information to stakeholders as well as just to investors. Let me just stop with that. A couple more slides, and then I'll stop. This just illustrates this, in many ways, the central theme that I've been describing. This is so Shell is a very obvious target in this space. Shell was sued in the Netherlands a year ago. Look at the second paragraph. The court, Shell lost the case. The court found that Shell is not acting unlawfully, but it must reduce its CO2 emissions in the future. So what it's saying is Shell is doing nothing wrong. And therefore, actually, in the accounts, you're not going to find anything. The financial accounts don't tell you the second part of this paragraph, which is that Shell's future business, by law, is going to be different from its past business. That's the implication of this ruling. So it's very similar to the Shell position, but it shows you the economic imperative. And here's a much more recent legal action taken 3 weeks ago. There's a firm called Client Earth, which is a law firm, but it's also an environmental NGO, and they sue on behalf of the environment. So they treat their client as being the earth. That's the idea. They are suing Shell. They are suing the directors of Shell. Look at the second paragraph. Shell is seriously exposed to the risks of climate change, and its plan is flawed. In failing to prepare for net zero, the board is increasing the company's vulnerability. In other words, Client Earth are not suing Shell because they're damaging the environment. They're suing Shell because the directors are failing to protect shareholder value creation. This is very clever, right? So actually what they're interested in is protecting the planet, because that's why Client Earth exists. But they recognize that the way to address this challenge is to say that by focusing too much on what they've been able to do in the past and not looking enough into the future, Shell are failing to protect the interest of their own shareholders. So this, I think, illustrates what's been a very interesting development in the last few years, which is the increasing investor orientation in this space. and the increasing extent to which the investor orientation and the societal orientation are aligned, at least for climate. With biodiversity impact and the social impact, I don't think they're anywhere near as aligned as they need to be. But with climate, increasingly, it's hard to separate the impact on society as a whole and the impact on future generations from the impact on the current investment community in terms of the information provided. Okay, I will stop there, and we have some time for questions.
Okay, thank you, Richard. I think it's a very interesting topic that you have given to us. And if I make something like a summarize of your presentation, that's due to the recent condition that what we have already got is not enough. So we need the future corporate reporting, and then you already mentioned that it seemed to me that the future corporate reporting is something like a combination of the financial reporting and externality reporting. So, okay, then now is the time for question and answer. I will read. We have 8 questions here from hang on. The number one from Agung Gede. Agung Gede is our college as well here. The question is, what is materiality for carbonization? And do standard organization will change our concept of an intangible asset? Can you get the question, Richard?
Sorry, no, I didn't get the try again. I didn't quite get the question.
What is the materiality for carbonization? And two standards carbonize. And two standard organization will change our concept of intangible asset.
So I'm not sure if I've understood the question. I'll try and answer it, and if I don't answer it, let me know. Okay. I think the so if you think about materiality with respect to carbon, then yeah, there is, on the one hand, there is a question of to whom is the information material, and on the other hand, there's a question of what comprises the information. So if the information is financially material, then it's an extension of corporate reporting as we have it, reporting to investors. If the information set is different from the point of view of materiality to society, then there's a different type of information to disclose as well. I think in the climate space, those two lenses come together. I think it's if a company has a significant carbon-related business or climate-exposed business, it's very hard to think of information that is societally important, that investors are going to say, we don't need to know, we're not interested. So that's changed a lot in recent years. The question then becomes, what is this information? And I think what's really interesting here is there will be, in terms of future of corporate reporting, there will be a massive development in supply chain information. So in order for a company to report on its carbon footprint, it has to know its suppliers' carbon footprint, and they have to know their suppliers, and they have to know their suppliers. And yeah, that includes the supply of capital goods and the supply chain of the capital goods that are purchased by the company, the buildings that are constructed for them, and so on. So there is a huge gap between the information that we currently have and the information that we would need to have, even more complicated for downstream carbon emissions. So, but again, I think the answer to those questions is quite close to known from both. Yeah, an investor wants to know what they're exposed to, and society wants to know what damage are you doing, and where are you doing it, and what are you doing about it. And they're quite similar questions.
Okay. Before I continue to the second question, I think that David's already raised his hand. Please, David, you can ask directly to Richard.
Thank you very much. And thank you, Richard. A great paper, really enjoyed it, and a really interesting perspective. I just wanted to make it probably a couple of comments, and I'd love to get your response. the extension of what you're talking about, which is a really important conversation to have, is that both administrative compliance expenses will increase in companies, but also likely extending that across public sector and not-for-profit charity organisations.
Yes.
And also there is a significant impact on the assurance side of things, of course, because the natural extension is to include assurance there. And we're, I think, globally seeing a real significant demographic change in terms of the availability of experienced auditors. So kind of an increasing complexity at a time when, I just thought I'd raise that. I'd be really interested in comments.
Yeah, very good questions.
Good. Yeah. So
when you in the process of introducing new standards, there is in general a cost-benefit evaluation, right? There's in general is society better off net of the costs of the new standard? There's also the question of where those costs fall, right? So you can expect, and I think entirely reasonably, you can expect a strong pushback from companies in all kinds of ways about that we don't have these data, right? And it's unrealistic to expect us, this time next year to have them, as it were. That said, there's enormous business opportunity here. So the big four and consulting firms and so on are recruiting like crazy in the sustainability space because they recognise the skill shortage and the market opportunity from all of this. So I think it's normal, I think, to focus on cost to the existing system, and also to think generally about climate and other issues in terms of it being a transition cost. Actually, it's also a massive economic opportunity. And to repeat a point I made earlier, the value of the economy that doesn't transition is lower than the value of the economy that does. Right? Yeah. So the economies have got the opportunities have got to be out there, but and you start to think about things like satellite data capture of natural resources and so on. There's all kinds of business opportunities in providing supply chain information. But a very significant and disruptive period of transition in reporting and auditing, I agree.
And probably, if I can be rude, just to follow up, the issue, of course, is the proportionality, and our sense of what we consider to be red tape is not often reflective of the real administrative value in what we do as well. So just another comment, but thank you very much. I appreciate it.
Thank you. Yeah.
Okay, thank you, David. The next questions, this anonymous, it said various type of stakeholders are interested in corporate reporting, and their needs are also different from each other. What's method that companies can use?
So the question is, different stakeholders have different informational needs, essentially.
The stakeholders are interested corporate, their needs are also different. So because the need is different, so what kind of the method?
Yeah, it's a very good question. And again, it's if you stop and think about that, you start to realize just how much corporate reporting is going to change, right? Because historically, the primary audience has been investors, and there are very clear channels of communication in the written report and in the whole sort of structure of meetings with investors and so on that serve that stakeholder. And it's by no means obvious that similar mechanisms work for different stakeholder groups, actually. And notice you've got two quite different audiences for similar information here. So it's one thing for me to say, which to make the claim I just made, which is that investors, in terms of climate information, are interested in quite similar information that society as a whole is interested in. Fine, but you've still got to communicate differently to those different stakeholder groups. And identifying who the stakeholder groups are in terms of environmental impact is much harder. In some cases it's impossible. In some cases, actually, it's future generations you're reporting to, right? And you can't do that. And then if you take consumers as a group, for example, well, so yeah, you want to be engaging with them in their product buying decisions and providing information in that context. That's radically different from sort of annual or quarterly reporting to your investors. So I don't have a good answer actually to that question, but the complexity is bound to increase with multiple stakeholders and different needs for information.
So it's depend on the situation, depend on many aspects, right? Okay, the next question is it good for firm to report forward-looking accounting statement in terms of its revolvement? Is it mandatory or voluntary? Where can we see the statement?
So, so notice one of the a really important point, and I'm not sure if it came across strongly enough. The International Accounting Standards Board is concerned with reporting historical information, first and foremost, what has happened. The International Sustainability Standards Board is concerned in part with historical information. What were your carbon emissions? What was your deforestation impact? But is much more concerned with what is your transition plan? What will you do? What risks do you face? So it's much more forward-looking in nature. And that makes it fundamentally different, right? You can't, to David's question about assurance, you can't audit the future, right? You can provide sort of reassurance that the organization is reporting externally the kinds of things that it's talking about internally, right? And that it's got processes in place that seem robust, right? But reporting on the future is fundamentally different. It's also, of course, opens you up to litigation in a way that reporting on the past doesn't. It's exposing in that sense, which in turn actually then provides an avenue for companies to try to close down the mandatory reporting. You can't expect us to be exposed in this way to provide plans about the future. So again, there's much that will be resolved over time. It's not yet obvious quite how it's going to be resolved. The SEC is really interesting on this, right? So if you read the SEC documents, of course, they are given the context all over the legal implications here, both positive and negative. So in a sense, that's probably the best reference.
Okay, the next question is the employees and the other staff of the company is one of the major assets of the company. Is there any best method to evaluate the human resources?
Okay, so notice that the going back to the Keynes quote about valuation, I said don't think in terms of valuation here. So people by definition are not assets, and so they're not counted in IFRS as assets. If you start to think about putting a value on them, then you're into the same reasons of subjectivity and uncertainty and so on that are why we don't put a value on intangible assets. That it's way too unreliable, and anyway, they're not valuable in and of themselves. They're valuable in combination with other assets and other resources. And that combination generates the overall income stream that the company generates. And so I'm not sure that the value of human resource in and of itself is worth even thinking about, actually. However, notice two quite different types of information here. One type of information is you're providing information to your investors about your workforce. So informing your investors about, these people are very particularly well trained, they have wonderful career opportunities, we have great diversity in our workforce, whatever it happens to be, investors might value that information. A very different audience is an external audience, which is, are there human rights abuses in your supply chain, and do you know about them if so? Right? That's much more of a kind of public interest social NGO framing of a question. So there's quite different types of reporting, but I don't think either of them is valuation.
Okay. Next question is from Sudarini, Ms. Sudarini, how can we estimate the amount of externalities that presented in income statement?
Well, I think the way I've described it, and I just described it very briefly, but the way I described it is around natural capital maintenance, right? So the idea is if you cause damage to nature, then that damage is observable. That damage is measurable in some way. And the question then is, what would it cost you to make good the damage, right? So if it's, you emitted X tons of CO2, the question would be, what is it going to cost you to offset that X tons of CO2, or what is an equivalent carbon tax rate that you would pay? Or there are different ways of thinking about how to cost it. If it's you have used and contaminated water in your production process, the question would be, what would it cost you to purify the water, to restore the water to the condition that it had been in previously, and so on. So you can see that those sort of questions are more or less difficult to answer depending upon the particular type of natural capital you're talking about. But the principle is very clear. The principle is that natural capital is valuable in and of itself, independently putting any price on it. So we're not trying to put a price on it. We're trying to say, you've damaged it, now you need to fix it. What's it going to cost you to fix it? That's a very different question from putting a value on nature.
Okay. The next question is from Yike Veliana. I think it's a very interesting question. Don't you think the corporate reporting, including 1 + 2 + 3 + 4, becomes overwhelming information for an investor?
Well, if you're an investor in Shell, you cannot say, I just want to see the accounts. I just want to see the financial statements, because the things that are going to change the value of Shell are mostly in the sustainability related space currently. So if you're doing your job as an investor in Shell, and by the way, with a company of that size, there's the financial incentive to do your job, then no, it's not too much information. It's the right kind of information. So there's a distinction there between what categories of information you need and how concisely the information is provided to you. So what you don't want is, if an annual report's already 500 pages, what you don't want is 2,000 pages. What you want is a different 500 pages.
Okay, but the most important thing is the contents of the reportings must be 1 + 2 + 3 and +4.
Yeah, so well, if you're an investor, it's 1 + 2.
Yeah.
But if you're an investor, the point is, box 2 is now important to you. It didn't used to be, but it now is. And if you don't think it's important, you're not doing your job. That's how the world has changed.
Okay. Next question is, how about sustainability reporting for startup company whose business operations are not too related to the environment? Do the startup companies need sustainability reporting?
Well, startups are much easier. Apart from the issue of scale, you're much more likely, the really big challenges are where there is sustainability transition required by existing businesses, right? So if you're a major business in aviation or something, then you're very heavily invested in doing what you're doing, right? And so the sustainability challenge is to find a different way to make money, bearing in mind you've got this embedded expertise and this embedded capital expenditure. If you're a startup, you can say, you know what, I'm not going to go into air travel. No, that's not a good place to make money right now. I'll go into something else, right? So I think in principle, the startups are more likely, by the very nature of the economic incentive of the system, the sort of the disruptive nature of capitalism, the startups are more likely to be going into solutions rather than trying to exit problems.
And the next question is, the proposal for CSRD you have mentioned applies to all large companies. What about medium enterprises and government organizations?
Well, yeah, governments are very good at not providing legislation for everyone else apart from themselves. I think that's generally true. But if you're a large company and you're required to meet those requirements, you will make it a requirement of your supply chain that those requirements are met. And so, and if you want to raise capital or you want to grow, and you're a medium company, you're going to be able to do that more effectively if you meet those requirements. So that's one reason why they're so powerful, and also one reason why this is not just a European issue. If you want to do business in Europe, if you want, whatever it is that you produce to be part of a European supply chain, then it's captured by that legislation. If you want to raise money from a European bank, it's captured by that legislation. So the filtering down of this is, I think, is potentially very significant.
Okay, this next question is very interesting. This will come from Felix.
Okay.
This made investor think twice before invest in company because the sustainable profit is less than IFRS profit?
Okay, so bear in mind, there is no measure of sustainable profit. So nobody knows, right?
Nobody knows.
The extent to which, right? So imagine if you did have that information, then what it would, imagine if you invest in a company and this time last year, it reported a large profit and that's why you invest and everything's fine. And then it produces a new statement which says, actually, our environmental impact is huge. And on balance, our net contribution to society is negative. Then you're going to think twice about investing in that company, right? Because then you think, well, hang on, this company is not going to be allowed by society to carry on operating in this way. Again, notice allowed by society means in the collective economic best interests of society, right? And so it does make you think twice, or it would make you think twice about making that kind of investment, as it should. And so look at, go back to BP's purpose statement. That's what they worked out, right? They've worked out we can't carry on doing this, and so we're going to have to do something else.
The next question is, I think this is two questions from one people. Said that good day to you, Professor Parker. Your concept corporate reporting to sustainability environment. What makes you interested in it? And then what is the hardest part to do research about environment sustainability?
It's a very good question. It's a very what makes me interested in it is just recognizing if you cannot look at global warming information and the rate of change, the acceleration in global warming, and you cannot have, it doesn't require much knowledge of the potential impact, and likewise on biodiversity and land use and so on. If you I can't remember the stats now, but it's something like two-thirds of species on the planet have gone extinct since the 1970 or some sort of insane rate of extraordinary destruction of the natural world. Now, whether you care about the natural world in and of itself, or whether you say no, it's just there to serve people, either way, what we are doing collectively is incredibly dumb. It's incredibly damaging to future generations. It's not, we're okay, but the potential. Imagine the sort of the impact of global warming is that Bangladesh is underwater, right? And all of then you're talking about millions and millions of people in a forced migration. And as I say, come back to where I started. You look at the pressures on Jakarta right now. These are very recent in human history that these pressures have been created, and they are catastrophic potentially. So I think it's unavoidably important as a subject, and whatever lens you have on it. And so working in that space just feels like a very obvious thing to do. In terms of whether it's easy to work in this space, no, it's not, because I think it's financial accountants, this is changing quickly, but financial accountants generally don't have much understanding of sustainability reporting and sustainability issues more broadly. I exaggerate to make the point. And experts in sustainability don't really understand accounting. And so if you try to bring the two together, you risk not being understood by anybody. And that's not an easy space. And the academic world is not set up to do interdisciplinary work. It's financial accountants do financial accounting. And within the accounting research community, there's a sustainability reporting community that have been doing wonderful work for many years, but largely separate from the financial accounting world. That needs to change. These things need to come together.
Okay. The next questions. How to determine the fair value measurement for non-financial asset?
Fair value for depends what
non-financial
kind of asset.
Yeah.
Well, it depends what kind of asset we're talking about. I'm very skeptical of fair value. I have a paper on fair value for non-financial assets. So I have a paper in Accounting Organizations and Society on this question of fair value for non-financial assets. And the problem, it goes back to the Keynes thing I was describing earlier. The notion of fair value is market price. And a level 1 fair value is an observable market price. That's fine, right? If you own an asset for which there is an observable market price, using level 1 fair value is fine, right? Level 3 fair value means there isn't a market price, so work it out, right? So it means make up the price that would exist if there was a market. And that, if you press the logic of that assumption, it's quite dangerous and flawed, I think. So I can see in some cases you might want to require level 3 because you're already requiring level 1, level 2 for a particular type of asset. So it kind of makes sense in the financial space. But for non-financial, I think level 3 fair value is misses the point actually of the information that the accounting system is able to provide on the whole.
If I elaborate this question, say something like how to measure. You mentioned about the capital. The natural capitals, right? So how to measure something like atmosphere?
Okay, but notice, so natural capital is not the organization's capital, right? So the notion of fair value is the company reporting the value of assets that it owns and controls. So natural capital, for the most part, is not assets that it owns and controls. So that's one thing. The other thing is fair value assumes that what you're trying to get to is an economic value.
But we have to take into account.
For reasons I described, that's not the way to go about it, actually.
Okay. Next question is, how does the development of the green economy affect accounting, and what should companies prepare for a green economy?
Well, I mean, everything I've just been talking about, we have to hope collectively that the future economy is greener than the current economy, or else our grandchildren are in deep trouble. That's the bottom line. So it is an economically smart thing to do to develop a greener economy. There's no question about that. So all the transition that's going on right now is all in that direction. Question is whether it goes fast enough.
Okay. I think the next question is very interesting because it's related to the recent condition war between Ukraine and Russia. Yeah. The condition circumstance between Ukraine and Russia right now can make a big impact to the future corporate reporting. For example, maybe one of them makes standard by their own.
it's so depressing. I mean, the Ukraine, Russia is sort of, it's not just depressing on humanitarian grounds, and you see the way these people are suffering, but also the economic environmental destruction, like say the society putting its resources into destructive weapons that demolish infrastructure, and goodness knows what the carbon footprint of a war is, but I imagine it's pretty high, right? So how does it change corporate reporting at the moment? I think it's not helping, because it's forcing a much greater focus on here and now, and not on the longer term. So fossil fuel is much more acceptable now than it was before the war started, because issues of energy security become more important. So I think it accelerates the negative feedback that has got us to where we are, and it's a really striking example of everything not to do, unfortunately.
Okay, that's it's already 15 question. Okay.
Good question.
Yeah, very. Is there any question from a participant that you want to ask to Richard? You may ask directly. Just raise your raising hand, and then.
I'm just going to plug in my laptop. It's running low.
Okay. Ayo, silahkan siapa mau bertanya. Mbak Nining, kita selesai jam berapa? 5 o'clock? 5:30? 4:30?
1:30.
Okay. No question at all, Richard. This 15 question is already been answered for you.
Okay, so I have a very practical and local question for you, which is, so I'm seeing somebody this afternoon who is working with an NGO in northern Sumatra, and there's a national park in the north west of Sumatra, and which is the only place in the world where there is rhino and ape and elephant and tiger coexisting, all apart from the orangutan, the other three critically endangered, and the orangutan endangers. It's a very precious ecosystem globally, one of the world's most precious. But I don't know how to pronounce it. It's Leuser. How do I pronounce that? Leuser.
Lycia. Leusia.
Leuser. So it's the Leuser. I don't know ecosystem, but I don't know national park.
Prof, itu Leuser, Gunung Leuser di Aceh.
Oh, this is Leuser. Leuseur. Leuser is the name of the mountain in Aceh. So the
it's Aceh, that's right. Yeah.
Yeah, that's right. Yeah.
How do I pronounce it?
Leuser.
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 All right.
Yeah, Leuser. Okay.
Okay. Now I know. Thank you very much.
Okay, thank you.
Right.
Thank you, Bu Emilia. Ya, Bu Emilia tadi ya yang. Okay, Richard, I think it's already time is fly very fast, and now it's 4:32. So I see here that head of department, Ms. Wiwi Supratiwi, maybe you have want to say something to Professor Barker before we close this seminar.
Yeah, I think we need to invite you next time in this year also. Do you mind to come to give a lecturing like this? Maybe the next 3 months, or I don't know when you have free time to do that.
Or maybe we have to invite Richard to Indonesia, Surabaya.
Oh yeah. because it's very interesting. Actually, I already asked question.
Yeah, I think so.
I have an Indonesian co-author, by the way, so a doctoral student, Tim Kasim, who is now at Bristol
Terima
University
kasih.
in the UK.
Terima kasih.
Terima kasih sama-sama. Okay,
Yeah.
thank you very much for your presentation, Richard. I think I will give it to the committee of this guest lecture. Meaning, maybe any something want to give to Richard, something like.
I think enough, Prof. Basuki. Maybe we can take a picture for documentation.
Okay. So just make your camera on so we can see your face, and then the committee will take your picture for the documentation. Please, anyone who's still off cam, make your camera on. Okay, ending.
Please, Sister Shalin, for taking documentation.
Okay, maybe I will start from the first page. 3, 2, 1. The second page. 3, 2, 1. Okay, the third page. 3, 2, 1.
Say cheese.
Okay, maybe it's enough. Just the rest till turn off the camera.
Okay,
yeah,
then.
Thank
Thank
you.
Thank you, Richard, for very, very interesting topic. Okay,
and
so
see you
maybe
next week, David.
Looking forward to it. Thank you very much for including me. I appreciate it. Thanks.
Oh,
Rick.
so the next week is David turn
Yes.
to become our guest.
Exactly.
Okay.
Yeah.
See you next week, David. Okay, then.
Good pointers from
Thanks,
you.
Richard.
Thanks,
you want
Richard.
to
Yeah.
give a closing remark for this session?
No, I think it's enough. Yeah.
Okay, then.
Yeah.
Okay. Thank you very much for all the participants that today's seminar or webinar is very interesting topic given by Professor Richard Parker. So I think I have to end this session. Thank you very much for everything that you already come to this meeting, and thank you for again. Please, we give applause to Professor Richard Parker.
Yeah.
Okay, thank you.
Okay.
Thank you very much, everybody.
Yeah, thank
Good rest
you.
of the day.
Yeah, see you next time.
David raise his hand or a clap hand.
Bye-bye.
Bye-bye.
Bye.
Bye.
See ya. Okay, see you.
Sehat-sehat ya, Prof.
Alhamdulillah. Sehat.